All right, so I'm going to start the video on responsibility accounting. So we'll talk a little bit about what it is, and that'll give us an overview for working on the examples that you'll have up on Canvas. So what is responsibility accounting? Responsibility accounting is the process of determining a few different things. First, the right level of authority for each manager. Level of authority, and we'll talk about the particular levels of authority that are included in responsibility accounting point of view. And also determining the right performance evaluation systems to encourage managers to use their authority properly. Some people talk about balancing three legs of a stool, or three different elements of organizational design. So responsibility accounting is an attempt to balance the manager's particular decision rights and responsibilities. In other words, what does a manager have responsibilities? What does a manager have the ability to make decisions over? What decisions does a manager have the authority to make? Not everybody has the authority to make every decision, of course. So you got to manage the right level. You got to balance the right level of decision rights and responsibilities with performance measurement. So what elements of a manager's performance do you measure? And then also rewards and punishments. And so all these things have to be balanced, or else managers are not going to have the appropriate motivation to do the right things and to not do the wrong things. And by rewards and punishments, I'm not going to talk as much about that in this class. I'm just going to sort of assume good things or bad things happen to managers who do their job well or poorly. But we're talking about pay raises, promotion, firing if people do poorly enough, or passing over for promotions, those kind of things. So what consequences are there for a manager's behavior? So that's the basic idea of responsibility accounting. So we'll give you a background of what I think is a helpful way to think about organizing a corporation or a business. And for this case, it doesn't really matter whether we're talking about a publicly traded company or a privately held company. Excuse me. For nonprofits, it's a little bit different, but some of the same basic ideas will still apply. We'll talk about a basic organization of a business. So if this box here represents the business as a whole, what is the reason the business exists? So we can have lots and lots of really rich discussion about why business exists, from sort of purely profit motives to broader concerns about making communities better off and all that. But there's lots of ways to think about it. For this standpoint, I'm really going to take a very narrow financial view of the organization, and I'm making it clear that I don't think that's all there is in the world, but that's sort of the focus of this particular way of telling the story. So if you think about what the organization as a whole is intended to do, and think about if you're the CEO, you're the top executive officer of the company. Well, what is your goal from the CEO standpoint? If we're thinking about profitability, we're thinking about really returning capital to shareholders. So who are the owners of the business? And again, this could be a privately held company or a publicly traded company, even really an ESOP in a sense. I mean, if you think about the presentations we had in class, an ESOP, the employees own the stock, and so if the company does well, the employees are better off. And so that's one of the primary ways that shareholders or that CEOs keep their job is to make money for shareholders. Now, how do shareholders get paid? Generally, they get paid two ways. One is in the form of dividends, and two is in the form of increasing stock price, which we call capital gains. And that stock price can be in the market for a publicly traded company, or it can be, again, if you think about the ESOPs, there's a formula that's used, or an evaluator, a business evaluation expert would come in and analyze the performance of the company and create a stock value. But either way, however it's determined, either by a market or by an analysis and evaluation, there's some stock price. The other thing that a CEO basically needs to do is, in order to keep the business afloat and out of bankruptcy, is he also do have to pay back any debt to lenders, and that's going to require cash flow. And so if you're a CEO, you're kind of, in a sense, you can think of what you're doing as making sure your two biggest sources of capital, equity and debt, making sure the providers of your two sources of capital are satisfied. Otherwise, the company's in trouble. So, primarily, we're going to think about in this exercise on responsible accounting, we're going to talk about the return on equity here. We're going to talk about the equity side of things. If I am a CEO, I need to provide an adequate return on capital and the return on capital depends on how much is invested. In other words, if someone invests $10 million in my business, they expect more net income, more dividends, more capital gain than if they invest only $1 million. In other words, there's a percentage. The more that's invested, the more dollars of return there have to be. So in order to know whether enough money is being generated, we have to compare the gain or the benefit to the investment. All right, so from the CEO standpoint, that's the way it works. Now, how does a business do this? How does a business provide some kind of benefit, net income, or that kind of thing on an investment? Well, let's start down at the lower level of the organization. So how does the organization get net income? Well, it gets revenue from selling things. So you can think about the sales force and the marketing force as providing revenue. But in order to have things to produce revenue, you also have to incur costs. So you have resources, you have things to sell to your customers, right? You either need to build products or you need to have people available to provide a service. Whatever it is, you have to incur costs so you have something to sell. Now, if you take revenues and costs and you combine them, revenue minus cost equals profit, right? And so here we have kind of our whole income statement. Down here at the bottom levels, we have sort of parts of our income statement, but here we've got our entire income statement. And so as you move up the organizational sort of chart, you combine more things. So you start with people who are responsibility just for revenue or cost, and then you move up the ladder, and then you have responsibility for profit. And then when you combine profit with the amount of investment that has been made, and investment is usually done for the purchase of assets, and then we're really sort of talking about people have responsibility for managing the investment return. So we have basically sort of three levels of responsibility in a responsibility accounting point of view. At our lowest level of responsibility, we have cost and revenue. And sort of a manager's first promotion from a non-management role into a management role often is in charge of just one of these, so either revenue center or a cost center manager. So when we talk about a revenue center or a cost center, we're talking about an area of the organization that has responsibility only for generating revenue or controlling costs. So the lowest level of management responsibility is a revenue center or a cost center, really responsible for just one of the two main portions of the income statement. Then the mid-level or the medium level of management responsibility is called a profit center, which has responsibility for both revenues and costs. So as you go up, everything below it sort of gets rolled up into there. If you have responsibility for generating profit, then you have responsibility for both revenues and costs. And this is important because often in order to make more revenue, you have to be willing to invest more cost. And so if you have responsibility for both of those, you need to be appropriately held accountable for not just necessarily minimizing cost, but optimizing cost. In other words, incurring the right amount of cost so you've got the right resources and products and services to sell to customers. And then the highest level of authority we're going to call an investment center. And the top managers of any organization, whether they think of themselves in these terms or not, are investment center managers, and they have responsibility for profit compared to the amount of investment. All right, so that's sort of what we're going to talk about. So one thing that's important not to forget is that an investment center manager has responsibility for managing the profit centers that are beneath the investment center. So really has responsibility for both costs and revenues as well. So even though we think of an investment center, sometimes the label can make us think of just investment, but we have to think about profits, revenues, and costs and investment. So why is it important to get these right? Well, it's important to get these right because if we want to properly evaluate managers, we have to know what they're responsible for and what decisions they have. We have to measure appropriately the level of responsibility that they have, so that way they will get credit for what they've done well. They'll be held accountable for what they've done poorly, but we also won't hold them accountable for what they can't control, and we will hold them accountable for everything they can. So let me give you some examples. So how can this be gotten wrong? So, most of us have had opportunity or have had experiences where we're frustrated at work because we're being held accountable for something that we couldn't really control. So as an example, a friend of mine was responsible. He used to work at a retail store, and he was held accountable for the number of people who signed up for this retail store's loyalty card. Well, by the time he started working at this store, most of the repeat customers had already signed up for the loyalty card. He can't force them to sign up, and he personally was not going to lie to them or manipulate them to get them to sign up. So he was held accountable for something that he really had no responsibility or really had no ability to control. So he quit, and he was, in his telling, of course, he was one of the better managers at the store, and knowing the guy, I'm confident he was one of the better managers at the store. But he was a good employee, and he was happy to keep working there, except they decided to hold him accountable for something he couldn't really control. So he got frustrated and quit. And turnover, we all know, is a problem when they're good employees. The other way that this can go, so that was a situation where he was held accountable for too much, and so he quit. You can also have a situation where you're not held accountable for enough. And this is one of the problems, and I realize the Enron example is almost 20 years old now, but it's still sort of the last big major corporate scandal that still haunts the business world. Just I think it is. But it's famous enough we can keep using it. One of the things Enron did wrong, Enron did lots and lots and lots of things wrong, but one of the things Enron did wrong was they got this story of levels of responsibility wrong. What they did is they had managers who were really investment center managers. They had managers who had the decision right and the responsibility to go seek investment and to invest in assets, to invest in new projects. So they would go up the corporate food chain, they would go to the finance function, and they would say, hey, give me $10 million or $10 billion to invest in this new project, and I promise I'll achieve adequate results. But they only evaluated them on profit, dollars of profit. So you have the authority to go ask for investment and to go invest in assets. But when I measure your performance, I'm only going to hold you accountable for the amount of profit that you generate. What do you think is going to happen? Well, what's going to happen is, and just think, your paycheck depends on generating dollars of profit. But the tool you have to play with to generate dollars of profit is other people's capital. Do you think you're going to be terribly careful with other people's capital when all you're held accountable for is the dollars of net income you generate? No, you're not. You're going to very quickly figure out that you're going to invest in anything that has a potential of earning a positive net income, regardless of how much net income you're going to get. So, what Enron managers did, among other things, again, they did lots of stuff wrong, but one of the things they did is they had managers who were investing lots and lots and lots and lots of money in projects that were not going to earn a terribly high return. So one of the most egregious examples is there was a project that earned $100 million of net profit, which sounds like a lot, until you realize what they had invested is $7 billion into this project, and that equals 1.4%. Excuse me, which is not a very high return. Even I can earn higher than 1.4% on $7 billion. I imagine there's a bank somewhere in the world that will give you a CD for 1.4% for $7 billion of cash. So, Enron's managers were held accountable not for the $7 billion of profit, not for the $7 billion of investment, but they just got credit for the $100 million of profit. So they kept making lots and lots of these investments, which meant their actual return on equity, their actual percentage, ended up being really, really low, and so that's why they had to start lying on their financial statements. When your financial statements are beautiful, you don't have to lie about them. When they're ugly, you have to lie about them. Or you shouldn't anyway, but you become tempted to lie about them. So Enron's problem was a problem of lots of things, but one of its problems was corporate governance. So I don't want you to be ignorant of these things. So this is the basic story of responsibility accounting. At the lowest level, we have cost center managers and revenue center managers. At the mid-level, we have profit center managers. At the highest level, we have investment center managers who are responsible for investing in assets in order to make a profit. Profit involves revenue and cost. Again, the investment center managers are responsible for everything. So how are we going to manage these things? How are we going to assign appropriate performance evaluation and measurement schemes? Well, starting from the bottom up. So for revenue and cost, generally we're going to compare performance against some kind of standard or budget. All right, so we're going to make some kind of a budget or a plan for the year, and then we're going to see how people perform. And budgeting is a very, very difficult process. There's a lot of information flow back and forth, and there's a lot of negotiation, and sometimes it's just a top-down imposed budget. Like, here's how much you're going to sell, whether you like it or not. Some organizations solicit information from lower levels to combine that on the way up and make sure the budget's well informed. There's problems with both of those approaches, so some trade-off is generally found. But either way, revenue and cost center managers are generally compared to a budget or plan for their particular area. So, for example, cost center managers, you've got an area of responsibility, and you've got a budget for that area of responsibility. And again, same thing with revenue center. You've got particular, if you're managing a sales force or marketing force, you've got a particular product or geographic region or some sort of area of responsibility, or maybe your company is organized broadly enough that you're responsible for selling lots of stuff. When we heard about the Novalex example, we heard about people who are responsible for cross-selling. So they had customer-level responsibility, and their job was to sell as many different products to that particular customer. So again, you've got some kind of measure of your area of responsibility. When we're talking about the profit center, again, we're going to do some kind of a comparison against budget, but the area of responsibility is going to be broader. It's going to include both the revenues and the costs in that area of responsibility. So in your costs side, you're going to be measuring some sort of cost per unit, or maybe total cost for the year. For revenue center, again, you're going to be measuring something like total revenues, maybe revenue per unit. Particularly if you're in a branding situation where you want to make sure your brands have a particular value in the customer eyes, you may want to be very careful about how much revenue per unit. You want to keep your prices sufficiently high, even if in the short run you could make more money selling products at a lower price. In the long run, that's going to erode brand value, and lots of premium brands have had to fight against that issue. So something like revenue per unit could be an important measurement where you might be willing to sacrifice a few sales at lower prices to protect your overall brand equity. In the profit center, we have to make sure we are keeping our area of responsibility for the right segment of the business. Again, it could be a geographic, it could be a product line, it could be particular customers that you're serving. Another friend of mine is a project manager for an engineering firm, and he's got several large energy companies, and he's responsible for particular projects on those companies. So he's responsible for revenues and expenses, costs on those particular projects. So his job is partly to do the bidding and to get the contracts to do the work, and then he's also responsible for making sure the work actually gets done. And so, in a sense, his P&L, his profit and loss responsibility relates to the particular projects for those customers. And then as you go up to the top level of the corporate ladder, excuse me, you're going to be held accountable for some measure of return on investment, or at least you should be if you're not Enron. You'll be held accountable for some measure of return on investment. So the very simple sort of approach we're going to use in this class to kind of talk about conceptually is a simple return on assets. So net operating income divided by the dollar value of assets. There are lots of different ways and lots of different tweaks and customizations of these approaches, but to kind of do a plain vanilla down the middle approach, we're just going to talk about return on assets as a primary way to measure investment center responsibility. There's some other things we're going to talk about. There's some downfalls to this measure. This measure has some problems. And so we're going to talk about some tweaks or some other approaches, but ultimately this is the one that seems to be most widely used. So as some of the examples we're going to look at going forward, we're going to talk about how these areas of responsibility, revenue, profit, and cost centers, how they compare to budget. And the sort of plain vanilla managerial accounting term for a difference from a budget is called a variance. It can get kind of complicated. One of the examples that we are going to talk about, the example can dive like 2 or 3 levels deeper than what I'm going to have you do for this course. But you can spend a whole career just diving into the intricacies of cost variances and even revenue variances. Some of these variances can get very complicated. Mostly for this course, I'm just going to kind of keep it at the high level. You're not planning to be cost accountants or detailed financial analysts. I get that. You need to be able to be conversant with those concepts, but I don't think you need to be diving in and pulling apart the various budgets yourself. So that's why we're going to sort of stop at the level we stop at for this course. If you want to take the cost accounting course, go right ahead, and you'll learn a lot more about variances there. So basically, we're going to talk about 2 kinds of measures: variances, which are difference from budgets, and return on investment, which is basically return on assets measure. Couple other things to sort of point out, different sort of concepts to keep in mind. When you've been taking your finance classes and you talk about return on investment kind of thing, the finance approach is sort of making the investment decision. And so they're taking the sort of life cycle approach. So what is the lifetime return on investment on a project? So before the project is made, or before the project is invested in, they sort of look at the whole timeline of the project, and they look at the cash investment, and they look at the cash flows back, and they discount all that back to time 0, which is today, and they say, does it have a positive or negative net present value? What's the return on investment going to be? And then they're trying to say, at this point, do we make the decision to invest, yes or no? It's perfectly fine, perfectly useful way to think about things. But that's a different approach that I'm taking in this class. What we're going to talk about in this class is we're going to take one particular time period. So after we've made the investment, what is the performance of the project during a particular time period? Recognizing that the time period of the whole project, the scope of the whole project, is much longer than the time period we're going to be evaluating. So I'm talking about in the post-investment world, after we've made the investment, how is the thing performing, how are managers performing, how's the project performing during a particular year. So that's why we can have a situation where, for example, we've got a $10 million return on a $60 million investment, and if that's the lifetime, is that you invest $60 million, all he gets $10 million back, you've lost $50 million bucks. That's a bad idea. But over the course of a particular year, that's a 16.6% return, if I'm doing my math correctly. And so that's going to be actually not a terribly bad return for a particular year. And we're assuming that this is an annual return over a longer period of time. So it's one thing to keep in mind is that we're taking a different point of view than you might have seen in a finance class. So some of the same concepts are going to be used, or some of the same terminology is going to be used, but it's a different way of thinking. The other thing that I want to talk about is, again, remember that what I'm doing is a plain vanilla approach. We're going to talk about very basic concepts. Everywhere you work is going to have different labels, different specific calculations that they do. Sometimes those are very wise, specific customizations. Sometimes those are just historical quirks. Sometimes the language is just whoever sort of first invented this report or who first started using this measurement. That's the language they started talking about it. But everybody's going to have, even if these same concepts are in use, terminology is going to vary. All right, so if what I'm talking about sounds close or similar to what you're talking about, it probably is close or similar to what you see at work. But the terminology is going to be a little bit varied.